Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo. On today's episode, we're going to be talking about why your financial concerns or really biggest risks occur once you pass the seven-figure mark in assets. What's really interesting about this is I think many Americans, they think, well, once I get to that $1 million mark or whatever that seven-figure mark is, I think they think that the rest is easy peasy. And what they don't quite recognize are some major risks really occur that could really explode everything that you've worked your tail off for, and or there's just concerns, right, that you don't realize are there until you get there. So we're going to be talking about three of those issues that arise, and this comes from a Nick Maggiulli book that he just came out with. It's called The Wealth Ladder. Now, I haven't read the book. I actually just purchased it, so I'm going to read that, and I want to provide some insights into that. But what I did here is a podcast that he held, and so I did some math and kind of double checked his work, and he raises a lot of good points. And frankly, with the clients that Alex and I have worked with, these are all valid. So without further ado, let's dive into today's episode. So I'm going to share my screen again. If you haven't checked our YouTube channel out, make sure you check out the YouTube channel because the visual side of stuff I think does help add the background to what I'm saying. So make sure you check that out on YouTube. So let me share my screen here. The first thing that we need to look at is this. When we are pre-seven figures in assets, what's really interesting about this is really you can affect a lot in your financial world because, let's just say you're making $200,000 a year and you're saving $20,000, $30,000, $40,000. Well, you get to choose where that is being saved at. And yes, rate of return helps build that, but you still have a big effect on where to be putting your dollars and the control of the risks that you've got. But once you get to seven figures, that risk does change a bit. And it's really interesting, right? So again, a $200,000 household income, like that's pretty common. And then, I'm using a $2 million figure here. Let's really analyze this. $2 million at a 5% rate of return. And we're just going to take this out for a 20-year period of time. So let's pretend this person's 45. In 20-year periods, if they don't save any money, that $2 million goes to $5.3 million. And really kind of checking the math, like $2 million in its first year, you can see it grew by $100,000 in year one. 2 million times 5%, that's $100,000 growth. Well, this person, even if they're saving 20, 30% of their income, so 30% of $200,000 is 60 grand, their investments are growing at a higher rate than their savings is. And when you have that, now there's a bigger investment risk associated with that, and it's critical to manage these investments correctly. That's a huge difference, right? As this is growing, managing these investments, trying to time the market, all the different things that Alex and I speak into all the time, it hits this person harder. Okay? And I want to reiterate something here that I think is key. Pre-seven figures, you're saving maybe more money than your investments are growing. But once you get to that seven-figure mark, oftentimes your investments are growing at a higher rate than your savings. And so your control factor is lesser because now you've got more money in the market and now you can't control what's going on. And there is some effect that maybe you're trying to chase the next level. Right? Imagine this person's trying to get to $10 million. They might make some choices that affect them negatively. So that's number one, right? Your investments are outpacing your savings. Number two, you're kind of feeling stuck, right? Stuck as in, again, if we've got, I'll just clear this out here real quick. I know I'm using a different figure here, but imagine this person has $1 million now, and they're saving $100,000 per year and using that same 5% rate. If this person's trying to get to $10 million, they need 28 more years. Well, oftentimes to get to that seven-figure mark, you're probably going to be in your your 40s at your earliest, most likely, and maybe even in your 50s and 60s. So if you're trying to get to this $10 million mark, 28 years from now, you're kind of feeling stuck. Like how are you going to get there? Right? It's a big difference. I mean, even if this person could save a ton more money, let's just say $300,000. Okay, well, $300,000. Well, now you're at 17 years, 17 years still to get that $10 million mark. Okay, again, the savings rate isn't as effective. And so again, this might make you make different choices, which is bad and good. Okay, so that's mistake number 2, or not mistake, but financial issue is feeling stuck with like what strategies to use. And this is definitely important why you should be working in coordination with the professionals in your life to make sure we're coordinating. It's not necessarily how big of the asset you're growing. It's can we turn on the income stream for you to live the life that you want? And then the last financial issue that bubbles up here is, and I've kind of iterated this already, is the risk of this money going down. I go into my $2 million thing here. Oftentimes if you're at $2 million in your 40s, oftentimes you're getting equity compensation, right? You're working for a tech company and they're giving you equity compensation. Well, oftentimes your equity compensation, you keep a large concentration in that. So imagine, you're working at any tech company, Microsoft, Apple, Google, what have you. You've got a huge concentration, maybe of this $2 million, maybe $1 million of it is in name that tech company. Well, if you have $1 million, 50% of your wealth in that company, now you've got 50% of your wealth that can take a huge hit. So 07 occurs, 08, right? That 2-year period of time, a lot of the tech companies lost 32%. So imagine your $1 million going down by 30%. Now you're down to 700. And then this other money, the other $1 million you've got in another portfolio, maybe it's not down as much, but it's still down. Your over-concentrated risk may derail the plan that you've got. So these concentrated holdings can lead to substantial losses. And so oftentimes shifting occurs from the standpoint of, okay, we want to get some rate of return, but we want to make sure we're preserving the wealth that we have so that the market doesn't make or break when you want to maybe pull back on the reins and stop working as much. Or maybe it's a legacy play, right? Whatever that is important to you. So I thought Nick brought up 3 really important pieces. When you get to that 7-figure mark, I think there's this misnomer that it becomes easier. I'd argue it actually becomes harder because the risk associated that is there. Pre-seven figures, you're controlling where you're putting your money. Your savings rate is typically higher than what you're getting in terms of an investment rate. So you have to have a coordinated attack for this, so you don't make the wrong decision at the wrong time. So that's what I've got for you today. I hope this episode was valuable for you. I know many of our clients have high concentrated risk in their stock. And I'm not saying, by the way, to sell out of that high concentration. It's more of having a plan so you understand that risk and make sure you're not setting yourself up for a huge loss of wealth at the wrong time. Hope this episode was valuable for you. Head over to beerandmoney.net if you have any questions for us at the Contact Us page there at the top. If you got any value out of this, share this with your friends, share it with your coworkers. The whole reason we started this podcast is to share hopefully tidbits of knowledge for you so you can take actionable steps towards your own plan so you can live the life that you want to live. Hope this was good. Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
822-8526.1, expiration date July 2027.